Hello, good evening, guys. I welcome you all to today's session. In this class, we are going to look at tutorial 2, problem sets 3 and 4. I'll start by sharing my screen so that you guys can see what I'm coming to do. Share my screen. 1 minute. Okay, good. We are ready to go. Okay, so I'm going to read the problem set 3 and we look at how best we can solve it. Western Industries has a debt to equity ratio of 1.5. The return on the market portfolio is 10.5% and the risk-free rate is 6%. The firm pays no taxes. A. What is the company's cost of equity capital if the beta of an identical leveraged firm is 0.83? Okay, so just like we did in tutorial 2, let's first of all write our CAPM formula. So I will start off by saying that in this case, cost of equity, expected RE is equals to beta of equity of a leverage firm into brackets RM minus RF. Sorry, I think I've turned my machine. Okay, sorry. So I'll say that expected RE equity of a leverage firm is equals to RF plus beta equity of a leverage firm into bracket 1 plus, sorry, into bracket RM minus RF. So in the question, we've been told that our debt to equity ratio is 1.5. Return on the market portfolio is RM is equals to 10.5%. RF is equals to 6%. And mind you, what the beta that we have here is beta of a leverage firm, right? But in the question, we were given the beta of what? Unleveraged firm. So then I can say that the beta of a leverage equity of a leverage firm is equals to beta of unleveraged firm into bracket 1 plus debt to equity ratio. That is, so then I can say that then beta of equity leverage is equals to 0. Because in the question it was given that the beta of the unleveraged firm is 0.83 into brackets 1 plus, and the debt to equity ratio is 1.5. Then I can say my beta is equal to 0.83 into bracket 2.5. And that gives me beta of equity leverage is equals to 2.075. Now, once I know this, then I can say my return on equity or the cost of capital, which is a return, is equals to REL is equals to RF. In this case, RF is 6% plus my beta which is 2.075 into brackets RM, which is 10.5 minus 6%. So I have 6 plus 2.075 into bracket 10.5 minus 6, and that gives me RE of L is equals to 15.3375. So to do 2 decimal places is 15.34%. That is to 2 decimal places. Now let's look at the B part. What is the company's cost of equity for an identical unlevered firm? So the B. So B. Now in this case, we are going to use M and M preposition to, right? And this is how they write it. Expected RE of a leverage firm is equals to, let me say, RE of unlevered firm, which is the same as the weighted average cost, plus RE of unlevered firm minus ID. That is this one is the interest on debt all over debt to equity ratio. In this case, there's no credit risk, so ID is the same as RF. So this is the same as RF. RD is the same as RF in this case. So then, from the A part, we know that expected RE equity of a leverage firm is what? 15.34. So I can say this is 15.34% is equals to RE of U plus RE of U minus the risk-free rate is 6%, or into bracket, the debt to equity ratio is 1.5. Right, 1.5. So what I can do now here is I have, when I multiply REU here by 1.5, I have 1.5 EU multiplied by plus this comes 2.5. RE of an unleveraged firm. That is this expression here, and this expression here gives me 1.5. So when I add that to the REU that I have already, that gives me a 2.5. That gives me the 2.5. Okay, so I think I have, sorry, let me leave here. Okay, so let me clear this part, so as you can see, sorry. All right, so let me move to the next new white marker board. Okay, so what I have here now is, let me, okay, 1 minute, sorry. So we know that 15.34%, 15.34% is equals to REU plus REU minus ID multiplied by the debt to equity ratio, which is 1.5, which we've written already. It's 1.5, sorry, multiplied by 1.5. So I'll make this 1 times. Now, if I multiply this expression by this one, I'll have 2.5 REU, right, equals to Then I multiply ID, but I already know that ID is 6%. From the question, we were told risk-free rate is 6% because we've already said when it is credit, when there's no credit risk, then ID is equal to RF. So I have 6 times 1.5, and that gives me 9. So in this case, it's 9 by negative 9, so it becomes minus 9 equals to 15.34%. So that means when the 9% crosses, it becomes positive. I have 15.34 plus 9. That gives me 24 points. So that is 24.34% is equals to 2.5 RE of unlevered firm. So divide here by 2.5. 2.5. So what I have here now becomes RE of unlevered firm is equals to 9.736%. Okay, so that is for the B part. Now with the C, what they are saying that what is the company's weighted average cost of capital? So the C, the weighted average cost of capital. We said there's no tax, right? Because there's no tax, they're the same as RE multiplied by equity over debt plus equity plus ID multiplied by debt over debt plus equity. Because there's no tax, this becomes the formula. Now we already know from the from the A part, what is the cost of an identical unlevered firm, cost of equity capital. If so, we know from the first part that RE, expected RE of a leverage firm is equals to we had 15.34%. So okay, we had this 15.34%. So I know this, I know this. Now in the question they said debt to equity ratio. Debt to equity ratio is equals to 1.5. Debt to equity ratio is equals to 1.5. That implies that debt is equals to 1.5 E, right? That means value which is equals to debt plus equity is equals to 1.5 E plus E, right? So let me move on to the next. So that means I have V, which the value is equals to 2.5 E. In that case, we said the debt is equals to what? 1.5 E. Then if I'm looking for debt ratio, then debt ratio is equals to 1.5 E all over 2.5 E. So this cancels this. So 1.5 divided by 2.5, which gives me 0.6. That means that the equity ratio is equals to 0.4. Then I can say my weighted average cost of capital is equals to, we had 15.34% multiplied by equity, which is the share of equity 0.4, plus the risk-free, which is that the ID is equals to 6%, multiplied by 0.6. That means I have 15.34 times 0.4, which is 6.136 plus 6 times 0.6, which is 3.6. So when you add the two, that's 6.136. That gives you 9.736%. This is a weighted average cost. That is without tax. Now the D part is saying that the D part. What would the cost of equity? What would the cost of equity be if the debt to equity ratio were 2? What if we're 1? Okay, so now from here we can say that, okay, we know the MM2 formula is our expected RE of a leverage firm is equals to RE of unleveraged firm plus RE of unleveraged firm minus ID multiplied by debt to equity ratio. So in this case, when debt to equity ratio is 2, when debt to equity ratio is equals to 2, then we know that the RE that we did earlier on, let's cross check it. The REU that we had was the RE that we had was 9.736. So you're going to have 9.736 plus then REU minus RID, which is 6, minus 9.736 minus 6, which is 3.736 multiplied by the debt to equity ratio, which has increased to 2. So in that case, you have it as 9.736 plus 2 times 3.73, 2 times 3.736, which is 17 which is equals to, in this case, is equals to 17.208. So you do it for the same case when, if it were to be 1, that means if it were to be 1, this side is going to change to 1. And if it were to be 0, this side will be changed to 0. And that is all. So let's move to problem set 4. Now, Wool has equity with a market value of $29.5 million. That is equity, market value of equity equals to $29.5 million. And that of debt is equals to 8 million. So that I can say the value of the firm is 29.5 plus 8, which is 37.8 So the first question is, what is the company's debt to equity ratio? So A, debt to equity ratio is the same as 8 over 29.25, which is 8 divided by 29.5. And that gives you 0.2. So round off to 2 decimal places, 0.27. Great. So the next question is, what is the firm's weighted average cost of capital? Now, the weighted average cost of capital is equals to expected RE of a leverage firm multiplied by equity over the value plus interest on debt multiplied by debt over the value. Because in this case, there's no tax. There's no tax. All right. So we already know. So what we have to look for is expected, this one. Now let's write the formula for CAPM. RE of a leverage firm is equals to RF plus beta into bracket RM minus RF. Okay. Now when you check the beta of the company's equity is. Now this one, you don't have to look at what we did in the previous session where we had to use beta of equity leverage is equal to beta of unleveraged. That is in the previous one. If you remember, I wrote something like beta of equity leverage is equals to beta of unleveraged into bracket 1 plus debt over equity, right? That's what I wrote. But in this case, because in the previous section, we were rather given beta of unleveraged firm, right? But in this case, we have been given the beta of this particular firm, and this particular firm is a leverage firm, so there's no point in doing this. So I clear this one off. I don't need it. Then I can say RE of a leverage firm is equals to, now my RF in the question, they said treasury bills that mature in 1 year yield 5%. So that is 5% plus the beta, which is 1.15 into brackets. My RM was giving us 11% minus the 5%. 11% minus the 5%. 11% minus 5%. Sorry, 1 minute. Yes, great. So when you do your total, you're going to have 5 plus 1.15 to bracket 11 minus 5, and that gives you 11.9. So that is RE on this is equals to 11.9%. Okay, so when I come, I'm going to write the weighted average cost of capital is equals to 0.27 into brackets 11.9 plus the what is that of the debt. So that means the debt, sorry, not 0.27, sorry. So if I'm looking for the debt ratio is equals to 8 over 3.75, which gives you 8 divided by 7.5. That gives you 0.21. That means equity ratio is also equals to -1 of the debt ratio, which is 0.79. Right, so I'm going to write here 0.79 plus, and that, so plus of 0.21 into bracket. What is the cost on cost on debt? When you check the question, the risk-free rate is 5%, so that is 5%. So I have 0.79 times 11.9 plus 0.21 times 5, and that gives me 10.45. So that means my weighted average cost of capital is equals to 10.451. So let's look at the next question. So the next question is, what is the cost of capital for an otherwise identical or equity firm? Otherwise, so this is similar to the previous session, but this one is the reverse. That is what I mean is we wrote the formula beta of equity leverage is equals to beta of unleveraged firm 1 plus debt over equity ratio, right? Now, in this case, we've been asked to find the cost of capital for an otherwise or identical equity firm. That is a firm that is 100% equity, right? So that means we know this one, and this one has been given as 1.15. So what I do not know is this, right? So what I can write is 1.15 is equals to beta of unleveraged firm 1 plus, and I know from the previous session, that is when you check from here, we said the debt to equity ratio was 0.27, which is this one. So, and then the debt to equity ratio is 0.27. So that means I have 1.15 all over 1.27. That is 1.27 equals to beta of unleveraged firm, that is 100% equity, 1.15 divided by 1.27, and that gives me 0. So beta of unleveraged firm is equals to 0.9055. That means I can see when I'm looking for the cost of capital, so cost of capital of equity, which is 100% equity finance, is equals to RF. We know our RF as 5% plus our beta, which is now 0.9055 into bracket our RM, and then RM is also equals to 11% minus 5% here. So I have 5% minus 0.9055 into brackets 11 minus 5. Sorry, 5%, not minus. So plus, and that gives me 10.433% as expected. What is the cost? That is the cost of capital for an otherwise identical or equity financed. All right. So this brings us to the end of today's session. Thank you very much. I've promised to spend 30 minutes. I'm sorry I spent 40 minutes on this one. I'm sorry for that. So, okay, so we meet next week. Bye.